good afternoon. You're tuned into Closing Trades on ET Now. I'm Anisha Jain. With me is Aisha Faridi, and the closing trades are not looking too smart, and that's because the Nifty has completely reversed course. It's almost in the red as we speak, so almost 200 points off the highest point of the trading session as far as Nifty is concerned. And even if you look at the Sensex, etc., they're all trading in the red. So markets subdued clearly ahead of the weekly options expiry. We are well below the mark of 18,200 for the Nifty. Bank Nifty, however, is outperforming a bit. Yes, that too is considerably off the highest point of the trading session, and the PSU banking names are lagging, led by the underperformance in SBI today. But the private banks are doing quite well. So whether it's Kotak Bank, AU Small Finance Bank, they are doing quite well. Separately, you have real estate as well as pharmaceutical space that's dragging its feet. So those two putting pressure on the market. And Aisha, what's also interesting is the fact that India is starkly underperforming, because if you look at the way how European markets have started, they are up anywhere between 1–1.5%. That cheer coming in from the probable resolution of the US debt ceiling. But for now, India is underperforming.
Yeah, India is underperforming. Haven't quite seen the cheer rub off from our global counterparts. We seem to be really in a zone of our own. Having said that, amidst a lot of earnings reactions as well, awaiting ITC, SBI is reacting to its numbers. While there has been a strong margin performance, remember the NIMs have come in at 3.8% versus the expectation of roughly around 3.5%. Slippages as well have come in lower than what the street was anticipating. Of course, a slew of other earnings as well, which are awaited today. But having said that, the operating expenses have come in higher by about 27.5% and 22% on a sequential basis. The PPOP has seen an uptick of about 25% and negative downtick of 2% on a Q-on-Q basis. So, nothing blowout in terms of the numbers to impress the street. Just bring up the stock price graph as well and show you how SBI is reacting to those numbers. That will just come up for you on your screens. Next, SBI actually is down 1.5%, and the reaction is coming only post the earnings, now settling around the 579 odd level. Let's also see what ITC is doing ahead of its numbers, considering the market positioning there. ITC also is going weak into its numbers, down by about 1.5%. Of course, for ITC, given the outperformance in the stock and the market positioning and overweight stance on ITC right now, it will take a lot of positive surprises to actually please the markets. ITC so going tempered into the numbers as we speak right now. A lot of other earnings reactions as well, like Anisha was just highlighting. So let's just quickly bring up some of those stocks in news for you and tell you what really is happening. SBI already highlighted, of course, good numbers from Indo Amines, from a Jindal Saw, Stainless. Honeywell, of course, was a blowout set of numbers. The stock gapped up on opening itself today, held out by about 8.25%, and since then as well has managed to maintain its gains. Andur Manganese, on the other hand, MTAR, Shalby Hospitals, Quest Corp, Gale, Webhav Global have all turned out to be a bit of a disappointment. Still awaiting numbers from a JSW Steel, from NTPC, from Power Grid, and of course the big one, ITC, like I highlighted. But good time as any, Anisha, to actually go across to our chartists and find out why is the global cheer not rubbing off on us.
Oh, well, yes, I don't know if it's a weekly options expiry nervousness or what, but let's try and decode that with Naresh Mirani as well as C.A. Rudramurthy joining us on the show. Naresh, you go first. What's your sense on the market, and should this dip be used as a buying opportunity?
So we are trying to form a new range, which is basically 18,000, 18,050 on the downside, 18,400 on the upside. So closer to 18,050, or at least closer to 18,100 is where you want to do a fresh addition of longs. In this period, I would expect more price action in the broader markets, in the mid caps and the small caps category. And also over the next 1 to 2 weeks, there should be a lot of results. Pending results should get done with. So for now, focused more on stock specific, index only on a dip to 18,050 odd levels.
Okay, so that's the take as far as the market setup is concerned. See, Rudramurthy, what's your take regarding the banking index? The PSU banking names are clearly dragging, led by SBI, but private banking names are holding out.
See, for me, both Nifty and Bank Nifty are making some time-wise consolidation right now, because the move has been very fast and swift. If you see Nifty from 16,800 to levels closer to 18,400, it hardly took any time. So right now, lot of people have also been on the sidelines having this left out feeling. So any small dip is also a buying opportunity, and these people will support the market on the downside. Yes, for last 2 days, we are seeing some amount of dichotomy where you are seeing Europe as well as US markets moving up, but then our market is just consolidating. But I feel this is just a matter of 1 or 2 days pause, and we have to resume our uptrend very soon. And I am on the camp where these are opportunities to buy on every dip. Don't short this market, but few people have already done it, and these people will start covering their short position once 18,400 is taken off on Nifty, and we will head towards all-time high. But however, for this long call, 18,100 on Nifty future will be my stop loss, and that has been a very strong support for very short term. So keeping a stop loss of 18,100 on Nifty future, use every dip as a buying opportunity, and we will catch momentum on the upside once this range of 18,100 to 18,400 is broken out. And then Bank Nifty for me definitely looks more positive than Nifty. And yes, PSU banks after SBI results is seeing some amount of profit booking. That has been because of too much of overcrowded trade in SBI. Everyone is long, and now in spite of great result, we are seeing some amount of profit booking. But I feel after that long trade has just got adjusted through these result play, I feel again SBI should move on the upside. So I am bullish on market as well as on PSU Bank. Just allow for a day or two of consolidation and then buy the dip.
Strategy is still quite positive on the banks as well as markets, and SBI too, say Rudramurthy is quite positive on. In fact, let's talk about some of the other price volume buzzes as well. Canfin Homes is seeing a bit of breakout from 18-month horizontal resistance zone. The volume today is 4x the 10-day moving average that we have seen, and it's trading above all its key moving averages. So today the stock is higher around 2%. You also have Godrej Properties, which is actually underperforming today. It's formed a shooting star candlestick pattern, seeing a breakdown from the upward sloping support trend line, and it's the biggest session decline that we have seen in 4 months. So quite a bit of weakness on Godrej Properties. And CSE, which has hit a 2-month high on an intraday basis, heavy volumes, almost 4 times the 20-day average as well. Naresh, from the 3 names that we talked about, Canfin Homes, Godrej Properties, CSE, what would be your view?
So out of these names, Canfin would be interesting because one of the few NBFCs which is trying to make a multi-year breakout could consolidate here. If we look at the little longer term charts, the stock made a peak around these prices of 670 to 700 back in 2018, then again in 2021, then again say just in 2022 also, where it saw a big correction from. So it's testing that major long-term resistance. I would expect some bit of a pause here, but going forward, the medium term, such a knock on the resistance for 4 or 5 times indicates that eventually the stock should break out above those levels. So at current levels, it's a buy and accumulate with a medium term outlook. Short term, there could be consolidation maybe for a week or two, and then maybe the next leg of the move, which could break out above the all-time highs. So very interesting long-term chart, a 6-year breakout in the making.
Even as Swiggy turns profitable, the big interview of the day has been around the QSR space itself. In fact, Nikun just short while ago caught up with Jubilant Foodworks MD and CEO Sameer Khetarpal on a whole host of things ranging from the demand slowdown that one is seeing in QSR, whether people are eating more burgers or pizzas, and when exactly will the inflationary pressures lift off. Here out a slice of that interaction.
There are a few short-term pressures that I see driven by inflation, driven by some of the pent-up demand that you saw post-COVID normalizing. And as I see the inherent latent or inherent demand in our economy or what consumers are looking is over a medium to long term is super robust. So I am not too worried about the short-term changes. I think the tide should turn around very quickly. Because of high inflation, price increases, consumer made choices towards lower ticket sizes, or they moved from a large pizza to medium pizza. But as inflation kind of stabilizes, I do expect this to bounce back relatively sooner.
Do you expect a bounce back in this year itself?
Yes, I think the later half of this year should see, because the base effects of higher inflation will be normalized, and therefore it should lead to more discretionary spending. I'm talking about the macroeconomic in general, but Nikunj, I do want to point to the fact that while yes, you do see short-term mix changes and consumers downgrading, the whole market is like the $50 billion, right? One eating out market is $50 billion, and pizza as a category is about $1 billion. So to me, the competition is, or the opportunity is far bigger than how we slice and dice the market, to be honest. So I'm more focused on internal driving technology, building the commissaries, opening stores, making sure the experience is great, launching the 49 rupee pizza to a gourmet pizza at 6.99. I think there is enough opportunity that my team is focused on, and that's what like keeps me exciting rather than a little bit worrying about some of the macroeconomic things.
If I look at the same store sales for Jubilant Foodworks and for Pizza Hut, there seems to be a decline in the pizza demand and there seems to be an uptick in burger demand. What is your view on the pizza category growth per se? Because that is the big question which perhaps we need to understand and address.
Sure. No, I think I will answer your question again. Firstly, the overall QSR or organized QSR as a service is minuscule when it compared to eating out. So it's less than 2%, and the competition is not necessarily with Pizza Hut or some other pizza selling chain. It is also with a samosa and a vada pav and an idli and a sambar, right? Because that's where the large market is. Now, having said that, coming to pizza specifically, cheese has been a decadal high in terms of price. There was huge, we face unprecedented inflationary pressures on oil, on wheat, and therefore everybody took.
What a beat coming in for ITC's PAT. It's come in at 5,090 crore rupees. The 18-hour poll was penciling in 4833. The, of course, key figure is going to be what they clock in terms of cigarette volumes and whether they come at par with the expected range of 13 to 14%. We just have the first flash with us. I don't know, Anisha, if you have more numbers, but we were expecting a revenue uptick of 7%. 4833, like I just mentioned, is the PAT figure that we were working with, and it definitely is a beat. We're also anticipating a good 340 basis point margin expansion, and you can already see the stock actually recover from the session lows.
Yeah, I don't have many numbers at this point of time, but it looks like that the gross revenue from operation has come in at 19,058 crores, much better than what we were expecting at around 16,000. But these are the consolidated numbers, I beg your pardon. So I'll have to compare them with the standalone numbers to get the right figures as far as the top line is concerned. But even if I look at the standalone revenue, that's coming at 17,500 crores. We were working with an expectation of 16,624 crore. So a big beat coming in there as well. And even with respect to the profitability, as we just highlighted, 5,086 crore is the figure. We were working with a number of 4,833. We don't have other details with
revenue
respect to the volume.
It's just come 16,398. So that's pretty much in line with what we were also factoring in, because we were working with a figure of 16,624 crore rupees. That's largely in line, the top line numbers. But yeah, it's the segmental breakup where all eyes are going to be.
Oh, well, yes, and with respect to the other details, the cigarette figure in terms of the segments has come in at 7,354 crore. And on a year-on-year basis, it looks pretty much flat, to be honest. It's just 7,288 crore that was there last year. So very, very minor bump up coming in as far as the cigarette, revenue is concerned. And even if you look at the other internals, I don't think that they are very positive at this point. And let's wait for the volume figure, and that will tell you of what really panned out, because 7,355 crore worth of cigarette revenue this time, and that compares with 6,443 in the year gone by, and last quarter that number was around 7,288 crore. So sequentially there's not much improvement, but year on year you can definitely see quite a bit of improvement as far as the cigarette volume, cigarette revenue is concerned. concerned. We'll wait by perhaps and get more details with respect to the other details. But we have the reactions coming in from the expert as well. Priyam Tolia, the senior research analyst at Axis Securities, joins us now. Priyam, hi, thank you so much for making time and speaking with us. First up, the margin figure has come in at 37.8%. The revenue profile seems to be around 16,400 odd crores, and the profitability has come in at around 5,100 odd crores. Your first take on the three key numbers that we have.
Yeah, so on the top line front, it is below our estimates. So we estimated around 8% of the revenue growth. So the numbers are quite miss on that part. However, we believe that on the margin front, the numbers have in line with our estimates. So we have to check on the ITC cigarettes volume part. I don't have the number as of now, but it seems that the revenue growth is below our estimates. So maybe because yeah, hello.
Right, Priyam, we are going to wait by for more numbers and perhaps the segmental breakup as well, and I guess the cigarette volumes, and then try and reconnect with you to analyze the numbers. Let's quickly cut across to the SBI chairman. He's addressing the media after their earnings.
Economic activity would be supported by improving rural demand too. The government thrust on infrastructure spending, revival in corporate investment, healthy bank credit, and moderating commodity prices will also go a long way in terms of supporting the Indian economy. Despite the increase in interest rate and its transmission, credit growth has continued to grow in double digit and has been broad-based across sectors in the financial year 23. During financial year 23, all scheduled commercial banks credit grew by 15% YOY, as against 9.6% YOY in financial year 22, while aggregate deposit of all scheduled commercial bank grew by 9.6% YOY compared to last year's growth of 8.9% YOY. In the Union Budget for financial year 24, several steps have been taken to push up the capital investment in the country, which will eventually boost the credit demand in the country. We expect credit growth to continue in financial year 24 also, although some moderation might happen here and there. In the above economic backdrop, let me now give some color on the bank's number for financial year 23 as well as for the quarter 4 of financial year 23. I'm pleased to announce that for the third quarter in running, we have posted our highest ever quarterly profit of 16,695 crores. For the full year, our net profit has crossed the landmark number of rupees 50,000 crore, which is the highest ever by any bank in India. Net profit for financial year 23 increased by 58.58% on a YOY basis to 50,232 crores, while operating profit at 83,713 crores increased by 11.18%. ROA of the bank for the year improved by 29 basis points on YOY basis to 0.96%, and ROE improved by 551 basis points to 19.43%. For the quarter 4 of the financial year 23, net profit stands at 16,695 crores, which is higher by 17.52% sequentially and 83.18% on a YOY basis. Most other core profitability metrics have also improved over previous year as well as sequentially. Net interest income for the year increased by 19.99% YOY on the back of improvement in yields and continued credit offtake. Domestic NIM also improved by 22 basis points YOY. Non-interest income declined by 9.73% YOY, mainly due to the MTM losses which we had booked in the first quarter. It was to the tune of about 7,000 crore. Other than that, our core income streams, that is fee-based income, have remained intact and have improved by 6.84% YOY basis. Operating expenses increased by 13.68% YOY as we have started building provision for the wage revision, which has fallen due from November 2022. There is some increase in overhead expenses, mainly coming through higher tech-related expenses like expenses on IT development, mobile banking, ATM, etc. And also the higher DICGC premium because of the growth in deposit. On the business front, credit growth has been robust across all the segments. Domestic advances grew by 15.38% YOY, headlined by retail personal advances, which grew by 17.64% YOY, and corporate segment witnessed a growth of 12.52% YOY. SME and agri segment have also witnessed a healthy double-digit growth at 17.59% and 13.31% YOY.
Phone Pay UPI Lite. Crazy fast.
You know, people often ask me why I left my steady job at the call center. I wanted more out of life. So, I launched my own startup. Do you want to know how? Then start up your own business as an LIC agent. You want it, we've got it. Great products, zero investment, leading organization, and unlimited opportunities. So are you ready? Now think big. Become an LIC agent.
Visit our website or contact your nearest LIC branch.
CNG car, there's no chance of storage.
If you get a CNG car, you've got to get a carrier.
CNG is good, but to get something, you have to give up something.
OMG! It's CNG!
Big boot, big appeal, big reaction. OMG! It's the Altroz iCNG.
राशि की स्कूल फीस, घर का किराया, कितनी जिम्मेदारियां हैं सर पे। तुम तो टर्म लाइफ इंश्योरेंस लिए बिना ही चलेगा।
पॉलिसी बाजार पे 1 करोड़ का टर्म लाइफ इंश्योरेंस सिर्फ 430 रुपए महीने से शुरू।
Burst of colors. Feels like a billion rainbows in my hand.
The rising women's workforce has been one of the world's most remarkable economic developments. Organizations and business leaders play a key role in ensuring that all employees, be it men or women, experience the same hiring process, equal pay and promotion opportunities. Presenting the Economic Times Best Organizations for Women 2023, powered by Femina. A platform featuring companies that have provided a growth atmosphere with equitable training and development opportunities for women to upskill and improve their representation across the C-suite. The event also honored and recognized businesses that have infused organizations with a sense of fairness that is built on equality, impartiality, and non-discrimination. Watch the episode at these times, only on ET Now. Brought to you by ET Edge.
When our big boss was MD, he used to take care of us.
And our Prince Sahab is busy ensuring his family. Oh, big boss, you?
He's busy obtaining term insurance for his family. After all, office is also our family, am I right?
Let's close the deal. Thank you. Verma ji, will you have tea with this prince?
LIC's Group Term Assurance Plan takes care of your office family.
Okay, back with closing trades right here ET Now, and the numbers are coming in thick and fast. Let me take it across to Vinny, find out what the ITC numbers nitty-gritties were, because it's a bit of a mixed bag so far, Vinny.
Absolutely a mixed bag, but yes, revenues did come in line. The impact on the revenue was mainly only because of the agri-business that we saw for the company. Agri-business got impacted because there were export bans which had come and we saw it last quarter as well. This quarter also, that is an impact that is coming from the total in terms of the overall revenues. But all in all, revenues saw a growth of around 6% coming in, largely in line with what we were expecting. EBITDA in line with what we were expecting as well, a 19% growth on a year-on-year basis. Profits have been healthy as well, 22% growth in terms of profit. Now, in terms of the breakdown that we've seen, cigarette business, yes, the revenue over there has seen a 15% growth, and around, as of now, the inferred number for the volume growth comes in at around 11%. We could say 10 to 11% in that range. It could be around that 11% mark. Other than FMCG business, so that's the staple side, that has done a good growth as well, 20% growth. And that FMCG business, the EBIT margin in that front has seen a good growth as well. That has seen a double-digit growth improvement in terms of the margins have moved to a double-digit now in terms of the FMCG business. Hotel business too, like expected, has seen a strong growth, doubling in terms of revenues over there. And let's not forget the segment result for hotels. That has also done quite well. 199 crores is what the segment result has come in versus a loss last year of 34 crores. So improvement surely seen in the hotels business as well. Paper business too, mild gains there, 2% gains on a year-on-year basis. While agri business, like I mentioned, is a bit under pressure. So all in all, an inline set of numbers, what we could say coming in from ITC.
Okay, so that's the take coming in on ITC. Let's track what happens with respect to the cigarette volumes as well. But in the meantime, I think we can cut across back to the SBI presser because the chairman there, Mr. Khara, was answering the questions with respect to how the outlook is going to be, what were the internals of the numbers. So let's listen in as far as the SBI management is concerned in the press conference.
If you could give us some guidance there as well.
I think one question itself is quite a heavy questions, multiple questions in one question. So you have taken the full advantage of the clause one question. Anyhow, I'll start with the first one, which you have in your mind is something which is very heavy on your mind is relating to expected credit loss. Well, of course, first and foremost, this is just a concept paper which has been introduced by RBI, and they have not yet formed up their views. And even if they have very clearly indicated in that concept paper also, even if it gets introduced, it will be spread over a period of 5 years. Now, let me share with you. When it comes to the ECL, it essentially means that the provision would be made based upon the expected credit loss. And expected credit loss is a probability of one is a loss given default, LGD, and also the probability of default. So which is nothing but a reflection of the underwriting standards and also at the same time how the book has been. Herein I would like to draw your attention to the fact that our corporate book is provided to the extent of 98%. And when it comes to our retail component, which is almost as high as about 42, pure play retail is about 42%. There our NPA, gross NPA ratio is somewhere in the range of 0.6. So one, I would like to say that the loss given default as it is low. And even the probability of default, which is nothing but a reflection of the underwriting, what we have seen for last couple of years is a very clear reflection of our underwriting standards which we are adhering to. So in that kind of a situation, I would like to mention that our non-NPA provisions as on date stands at about 35,500 crore plus. So as far as our readiness is concerned, we will simply wait for the RBI guidance in this matter. And once the guidance comes in, we are very well equipped to deal with the scenario. And at some stage, we have done some calculation, but those numbers are much lower as compared to what additional provisions we are already holding in our balance sheet. So first and foremost, ECL as of now is a fiction. And if at all it becomes a reality, we are very well equipped to deal with without having any impact on our balance sheet. We have always followed the principle to insulate the balance sheet fully, and our balance sheet is completely insulated from any future potential events also. Now, your second question, which I can recall, was essentially relating to the the growth numbers, whether it is credit growth guidance. And also, your one question was relating to whether the kind of slippages which we are seeing, how will it look like going forward? I think, to my mind, the best of the answer for this question would be to look at our SMA1 and SMA2 book, because this is nothing but a reflection of the likely stress which could be there in the book. So, if you look at our SMA1 and SMA2 book, we have seen very clearly that there's a definite reduction in the SMA1 and SMA2 book over the period of time as compared to March 22, where it was 3,544 crores, SMA1 and SMA2. It peaked out somewhere around 8,000 odd crore in September 22, but again it has come down to 3,200 odd crores. We are in a position to have a very effective follow-up mechanism, and we are in a position to ensure that we recover all these stress accounts. So I think, to my mind, the quality should be what we are seeing today. We should be in a position to sustain. The third question was essentially relating to the growth. I think we are witnessing decent growth both in corporate and retail, and also even in SME as well as in agri. So I think, to my mind, the kind of activity which we see on the ground, which very clearly means that we should be in a position to address the economy's growth requirement. And I would like to also add that the macro aspect is something which will be a very, very critical component, and the kind of focus which is there in the economy for the economic activity, this will certainly offer us opportunity to grow as far as our loan book is concerned.
Thank you, Ritu. The next question is from Siddhi Nayak of Reuters. Siddhi, please go ahead.
Hi, so Siddhi here. Just want.
Components of that 12 to 14 will be spread across. But I mean, the kind of activity which we see on the ground, I think corporate, we expect that we should be in a position to see somewhere around 10 to 12% kind of a growth in corporate book.
Another important factor which I could see in the result was the sharp decline in the provisions. How should one read into it? Quarter on quarter, you are surprising market with that.
It is attributed to the better quality of assets which we have, and also by virtue of that, we are not compelled to have any aging provision because of better quality of assets.
Thank you so much.
Thank you, Ankur. The next question is from Abhijit Lelia of Business Standard. Abhijit, please go ahead.
Okay, so that was the key takeaway from the SBI press conference, that they're expecting credit growth to be between 12 to 14% going forward, saying ECL right now is based on probability, so they're not talking too much about what impact could ECL have. The chairman, they're saying that it's better for ECL to get implemented and then try and understand what the impact is going to be. But for now, the headline coming in that 12 to 14% credit growth is what they're expecting going forward as well. Let's take the conversation ahead and welcome on board Abhiram Vilaswarapu. He's the head of India Equities at BNP Paribas as well. Abhiram, hi, thank you so much for making time and speaking with us. Let's start with financials itself. SBI reported its numbers. The credit growth is expected to moderate to around 12 to 14% going forward. What's your take on the public sector banking space?
More than just public sector banking space, I would kind of step back and highlight the fact that financials is the one sector that we are most positive on at the moment. Till late last year, we were focused a lot more on just private sector banks and especially the large ones. But over the course of the past few months or so, we've been considering more outside of that space, including some of the public sector banks as well as NBFCs. So broadly, the thinking behind that is that loan growth across the system is still pretty strong. Balance sheets are quite good. In fact, may not been this good over the past decade or so. And we think that banks are just getting more and more interested to lend beyond their prime segments. And all of this actually makes for a good case to be overweight financials.
Right. The other pocket of interest, or rather much the talk of the market, Abhiram, has been what you're seeing within the QSR space. And clearly a marked slowdown is what one has seen purely because of, I guess, the inflationary concerns. And, we could see that with not just the QSR numbers, but even the DMart, for instance, the price-conscious consumer segment. What is it that you are making of this now, and how one should look at investing within that?
I broadly agree with you, actually. In fact, if you look at the whole consumer space, and for a brief while, I'll focus on the price-conscious consumer, like you mentioned, which would be more in the consumer staples area. I think this quarter is probably going to be the best quarter for some time, because not only do you have some amount of price benefit, as well as some benefit from lower raw material prices. But as we progress into the second half of the year, chances are that some of that revenue growth and the pricing gains that companies have taken may taper off. And raw material prices, even though I think they will still remain benign, but earnings growth may not be as good as what we are seeing in this quarter. So in consumer as a whole, actually, we're seeing, what should I say, a two-speed kind of a situation where in some segments, especially in the higher end discretionary areas, volumes are still quite good. Think jewelry, for example. But as you keep going down the chain, and that's when both in urban as well as rural, we're starting to see some stress, and maybe that this is an area to be extremely selective going forward.
So that's the take coming as far as the QSR space is concerned. But just to talk about the point about the earnings itself, we are at the fag end of the earnings season. We went with very little expectations into Q4. But what's your take after the Q4 earnings season? Do you think the pace of downgrades is likely to slow down from here on?
Let's look at it this way. We're probably about 70-75% into the earnings season. And the results so far, at least from an earnings perspective, are more or less in line with what we've seen in the past, let's say 7 or 8 quarters. However, the top line has not been as healthy as we would have expected. Normally, by this stage, you would see half the companies would have surprised positively on the top line. This has normally been the trend. That said, this time we're looking at more, maybe 30-35% of companies have done so. So what this clearly tells you is that earnings are being made up quite a bit due to benefit of lower raw materials and prices rather. And therefore, I would say this is a mixed kind of an outcome. But what's happening with India is actually beyond just the earnings of this quarter. If you step back and see today what we have globally is interest rates peaking. Second is the data that's coming out of our peer countries, for example, China, has not been as good as people expected. And the third bit is that oil prices are actually falling in commodities as a whole, in fact, and that is a benefit for an importing country like India. You put all of these three together and then say that earnings are more or less in line, and that makes for a decent kind of a situation for equity markets, at least in the near term. And that also explains why we've had about $6 billion of inflows in the last 3 months.
Okay, so that's a take coming in with respect to the inflows, and financials is one space you're positive on. But what's your take regarding, IT sector? Do you think the worst is already behind, or there's a lot more that is likely to come in the negative sense for the IT sector?
Well, going into the results, I was, of the view that the results may not be that great, but that a fall in the stock prices may be a good opportunity for long-term investors. That view has not changed a whole lot. I still kind of maintain that view, and that's backed by the fact that deal flows are pretty strong. Indian companies are still gaining market share, and there's a whole digital angle that's still ongoing, and that's not as discretionary as people make out to be. Now, that said, I wouldn't be surprised if we have another weak quarter. I mean, one more weak quarter, and after that, things start to pick up. Now, the big risk to this entire call is the fact that there could be a mild recession in developed economies in the second half of the year. Now, if that recession is any worse than just being mild, then I think that they could lead to a further round of earnings cuts. So simply put, I would be positive at the moment, considering that the fundamentals are still okay and stocks have corrected. That said, I'll keep an eye out for what's going to happen in the second half of the year and maybe play it slowly.
Before we let you go, Abhiram, then what should be a realistic return expectation from the equity market this year?
Well, our Nifty target is 19,250, which would imply like something like a 5% upside. And that view has not really changed. In fact, if you see what the markets have done year to date, it's probably flat to slightly positive. And so expecting some kind of a moderate return from here is not unthinkable. I mean, think of it, in the second half, you could also have a couple of risks coming up, right? At the end of the day, there could be a recession in the US. Interest rates have peaked, but the market is expecting rate cuts in the second half. God knows if that will really happen. So there are some risks as well. So it's good to have moderate expectations for the year.
On that note, Abhiram, we'll let you go. Appreciate you joining us on the show. Moving on and welcoming on board Siddharth Khemka. Then he's the head of retail research at Motilal Oswal as well. Siddharth, hi. Let's begin by discussing Restaurant Asia and the entire QSR space, because that stock is on fire today. 14% higher. We just spoke with the management of Jubilant Foodworks as well. Sapphire, Devyani, how are you looking at the QSR space?
Clearly looks split as of now. We saw results from Jubilant Foodworks, not that great. Same-store sales growth was not that strong. The outlook, at least for the near term, is a little bit modest, especially on the raw material front, where the expectation is of consistent, you can say, cost to remain at elevated levels, especially some of this raw materials like cheese, wheat. On the other side, we saw very good numbers, great set of numbers from Restaurant Brands Asia. They have shown growth on a same-store sales growth of more than 8%. The store expansions have been pretty good. And the outlook is pretty sanguine, both in terms of margins. They have expanded margins, and they expect FY24 to see further growth therein. Similarly, if you look at some of the others in the pizza segment, they are also witnessing some kind of pressure. But again, on the other side, Westlife Food, which is McDonald's, that is also consistently witnessing strong growth. So I think it looks a bit segregated right now. The overall outlook on the QSR space remains pretty strong. We have seen that both out-of-home consumption and food delivery business both have picked up, and with games like the IPL, and we have the upcoming World Cup later this year in India, the consumption for the QSR services will remain strong. So overall outlook remains positive. But for Jubilant Foodworks, the near term, 1 or 2 quarters could be under pressure. But definitely RBA continues to report strong numbers, and the view there is very positive.
Right. Just looking at a couple of other movers, and AU Bank continues to hold the pole position today as well. It's higher by about 2%. Bajaj Finance going strong, 1% higher there. Chola Finance as well looking strong. You've got a Whirlpool up 2%, and MCX, which is seeing a dash of about 1%. The breadth of the market, though, has gotten challenged. Where in the week, in fact, we have only a 39 count standing to the advances within the F&O universe, and a count of 152 standing to the reds as we speak right now. ICICI Bank, Bajaj Finance, Bharti, HDFC Bank are some of the names which are actually holding out, but a large part of the Nifty as well is in the red. L&T, ITC, SBI. In fact, look at SBI. It's now down a solid 2.25%, reacting to its numbers. Just bring out that stock price up for you. 2.25% lower. It's pretty much around the session lows. Naresh, let's quickly get a chart check going on SBI, and how much more weakness do you see here?
So, State Bank of India has been facing that resistance around that 590-600 mark, which is where it started correcting from last quarter as well, last quarterly results. So that's a resistance area. In the near term, 550, 565 is a support. So we are getting closer to that. That is the swing low for the last 2 weeks. So I would expect it to bounce back from 565 odd levels and get into this range of 565 to 600 in the short term. Overall, longer term trend still continues to remain strong. And this dip towards 565 could be a trade wherein one could keep a stop loss at 550 and go long.
Just looking at some of the other buzzers as well, while of course SBI is seeing an earnings reaction, so is ITC. By the way, some of the other, breakdown of those numbers are out. The cigarette volume growth is expected at around 11% for the full fiscal, I'm assuming. There's of course been strong performance that ITC has seen in the hotel segment. The FMCG EBIT margin is in double digits, and the agri-business got impacted because of the export ban. So if you talk about FMCG, cigarette revenues, they've come in higher by about 14.25%. FMCG others, that's other than cigarette, that's come in higher by about 19.5%. For hotels, it's of course been a bumper one on a year-on-year basis. It's 100% appreciation, but that's only because the same quarter last year you still had hotels as an industry reeling from COVID. Agri is actually down 18%, and the paper business has seen an uptick of about roughly 2% coming in. Rudra, if you could just analyze the charts for ITC for us.
For me, ITC having made a strong base formation from levels of around 370 to 390, it consolidated and gave a big breakout. From there, non-stop ITC went to levels closer to 430. Now again, it is making a consolidation, and if you see the 20-day moving average, it is somewhere closer to those levels of around 410, 415. So I feel ITC, even if it consolidates at current price or gives any dips to levels closer to that range of 410, 415, I will be a buyer. So ITC looks very, very strong, and having moved enough, still there is space for ITC to go further from here. But this move from levels closer to 360 to 430 zone has been very fast. So it can make that 1/3 or a 50% kind of a retracement of this up move, and strong support emerges at around 400, 405 zone. So I will be a buyer in ITC on any dip, and look at targets of 500 to come for 1 year from now.
That's a take coming in as far as ITC is concerned on a technical basis, but let's go across to Siddharth and get his view as well. Siddharth, what's your reading of the ITC numbers so far?
Yeah, Nisha, so I think we were expecting about 13% volume growth in the cigarette business, which looks around 11 to 12%. But bearing that, if you look at the broad numbers, they have been pretty good, both in terms of margins as well as in terms of growth. So if you look at the overall net profit, it jumped 21%. Our expectation of about 4,700 crores, so it came at 5,000 crores, so much better than that. The margins, as I said, has been improving, and especially if you look at the non-cigarette FMCG business, we have seen the highest margins at above 10%, which is very heartening. So overall, I think the stock definitely has moved up in the recent past. We are expecting a good revival in the cigarette demand. The hotel business continues to do well, that we have seen across the sector, be it Indian Hotels, Lemon Tree, some of the smaller names reporting very strong number. We have seen occupancy, average room rates on record high levels during the March quarter. So that continues to aid the hotel business. And as I said, margins aided by lower input costs and attractive valuation. That makes us pretty much positive on ITC. That continues to be our preferred pick from a 1 year perspective. Our target price is about 450. So at the current junction, as we heard also on the technical basis, the stock has moved up. Risk reward is not that favorable. Any dip could be a good opportunity for investors to look at, to enter into ITC.
And what about SBI then? What's your view with respect to the numbers coming in from SBI? Because it didn't look particularly bad, but the stock is losing steam. Maybe some profit booking, you believe? Has the numbers and the performance peaked in your assessment?
Another set of numbers, great set of numbers from SBI, much higher than our expectation across. So if you see the net profit growth of 83%, it was 10% higher than our expectations, aided by strong operational business, also lower provisions. NI grew 29%, which was marginally in line with our expectation. Asset quality has been pretty good. The slippages have come down, NPA ratios have come down. The company made lower provisions. We heard the management, so outlook remains pretty strong. But what we are seeing is that margin expansions or the NIMs could normalize from here on. and the growth continues to be pretty strong. We are expecting, if you look at on an overall basis, we are expecting the business to be driven by retail growth, which is likely to remain strong. SME corporate segment has also been pretty stable. So overall, we are expecting the ROEs to improve over the next 2 years for SBI. So ROEs of 1.1% and almost 18% of ROEs. So that should be pretty good. If you adjust for the subsidiaries, on a standalone basis, the bank trades at less than 1 book. So definitely a lot of room for upside. Today's reaction could be more towards the up move that we have already seen in the stock price just before the results. But overall, very positive view. It's our preferred pick within the entire banking space.
Okay, that's what our experts are talking about banks. But let's move on and let's get you some BTST trades going before we get you more analysis on the markets. Naresh, let me come to you first. Your BTST ideas.
So that would be one, a sell on Divis Labs with a stop loss at 3,200 and a target price of 3,000. And second is a buy on Axis Bank, which has come back to a good entry point. Stop loss at 908 and a target price of 940.
Right. And Rudra, let's have your picks as well. Any BTST trades?
Yeah, I have both on the buy side, and today's move on index has been only because of expiry. I feel market should go up from tomorrow. So I have a buy call on Bharti Airtel, which has been very strong. Post results also, this stock which made a minor correction or profit booking is now moving on the higher side, having broken 795 and staying above that. Bharti is a good buy to me. Looking at targets of 810 with a stop loss of 795. And I have a second buy call on MRPL. This stock again has gone above those levels of around 65, 66, which has been that resistance zone. So now looking at targets of 71 with a stop loss of 64 on MRPL.
MRPL, but pull up the stock of JK Tyre, that's trending down by around 10%. Of course, it opened on the back foot, but since then there has been more pressure. The management told us that they're expecting margins to improve from here on, but doesn't seem like that the street is buying it at this point of time. But what street is buying is definitely food of Swiggy, because that has managed to turn profitable as of now. 9 years after its inception, it has finally hit the green when it comes to the bottom line. Let's go across to Sharad to get the lowdown on the growth roadmap, because remember, tomorrow Zomato will also report its numbers, so the expectations are quite high from this space. But first up, Sharad, what's the update with respect to Swiggy's performance?
Well, yes, an important update coming from Swiggy, and CEO Sriharsha Majety has stated in a blog post as well as on Twitter that the company's food delivery business has turned profitable as on March 2023. He did state that the peak of the investments is behind the company and it's going to look ahead in the profitability, and they've also stated that they are on track when it comes to the contribution neutrality for the Instamart business. And also the company as a whole is one of the few global delivery food companies which has actually achieved profitability in less than 9 years of the inception. So a very strong positive commentary coming in from Swiggy. And do remember this profitability number which the CEO has stated, this includes the adjustment of all the corporate costs excluding the ESOP cost. So a very positive development coming over here. And do remember, over the last 2 weeks there were valuation markdowns coming in with almost a 49% valuation markdown, which was the second one by Invesco. And yesterday itself, Baron Capital also reduced the valuation by 34%. Earlier, the valuation of Swiggy was more than $10 billion. And now the markdowns have come in the single digits. Apart from this, Swiggy is also getting ready for the IPO and is expected to come by September 2024. And before that, they are expected to sell the kitchen service business in a share swap agreement of kind of getting almost a $40 million inflow by selling this business. Now, looking at the financials also, for FY22, the revenue almost doubled to 5,705 crore rupees. But on the other hand, if you look at the losses, that swelled up and doubled up to almost 3,600 crore rupees.
Right, and talking about food aggregators, there's Zomato, which is set to report its numbers come tomorrow. Winnie is here to tell us what to expect.
So the food delivery aggregator Zomato is set to report its numbers. Quarter-on-quarter basis is what we're comparing it on. Revenue is expected to see a growth of 9% on a quarter-on-quarter basis, while in terms of the operating performance, we're expecting an EBITDA loss this time around, 359 crores versus 265 crores last quarter. Losses of the company expected to remain almost flattish, 356 crores versus 346 crores last year. Food delivery business, that is expected to see a better growth coming in this time around. The GOV though is expected, GOV is gross order value, that's expected to remain flat on a quarter-on-quarter basis. You know, that concern is there around those discretionary spends, lower order frequencies. That is something that could maybe see a slight bit of an impact. But overall, food delivery business is expected to see an EBITDA of around 40 crores is what we're expecting. Contribution margin is expected to see a marginal decline for the food delivery business. Unit economics actually is something that will be in the food delivery business is likely to be steady. Other than that, Hyperpure business expected to see a 20% growth. Blinkit expected to see a resilient growth as well. The GOV growth over there is expected to be 14%. Commentary, what are we focusing on this time around? Focus on the profitability and orders across food delivery, quick commerce business. How is that shaping up? What is it in terms of the comments on the food delivery business seeing a recovery? Q3 was a bit subdued. Are we seeing a recovery there? Update on the Blinkit front. Also, in terms of the demand environment, what's that shaping up like? Let's keep an eye out on that in terms of commentary.
We'll keep an eye out on all of that. But Siddharth, you guys have been quite positive when it comes to Zomato, right? You're not expecting any big disruption to happen with ONDC coming in. And what's the kind of upside you see? Because the stock has been around that 60 range for quite a while now.
Yeah, Nisha, I think there has been some chatter around the entry of ONDC, but what we clearly see is that it is at a very pre-stage level. It's restricted to one city. They have offering something like the first time free delivery. What we are looking at that the entire food delivery business in India is set to grow rapidly, as we have just seen last 2 quarters. Even Zomato has been turning EBITDA, adjusted EBITDA profitability is something that they are trying to achieve. Swiggy has just reiterated that ONDC's entry would only expand the overall market. What ONDC also does is that you need the delivery partners, you need platform players to plug into its platform. It is by itself not going to have the people or the restaurants, but there will be some other players. So definitely a challenge, but I think that should be positive for the entire space. Zomato by itself has been showing pretty strong growth. We are expecting almost 30% revenue CAGR over the next 2 years, driven by higher penetration, higher proportion of transacting users, and also the other businesses like, for example, Hyperpure should show a stronger growth of almost 36% CAGR, and Blinkit should also start contributing meaningfully over the next few years. So our target price is currently at 70. We'll definitely review post the numbers tomorrow, but we remain positive and see that the entire food delivery business should see a strong growth, and Zomato being the market leader with 55% market share should be a key beneficiary.
Siddharth, we let you go on that note. Rudra as well as Naresh, you guys, thank you so much for taking the time out as well. Closing in a little bit weak for the day. 18,134 is where we're currently at. But yes, from almost near that 18,400 print, it's a bit of a cool off that the markets have seen. The two big culprits today have really been ITC as well as SBI. Them reacting to their earnings, and a bit of negative reaction coming in there has definitely weighed in heavy on the markets and the market sentiment as well overall. But yeah, we've really been a solo ship today. The global market share hasn't rubbed off on us at all. But on that note, we're going to wind it up right here on this edition of Closing Trades. Thanks for watching.